So what happens if you're planning to retire and you happen to have bad timing and retire right at a market top, like 2000 or 2008? And let's say that your retirement plan is to use the 4% rule and distribute 4% of your portfolio, grown by 3% inflation, for the duration of your retirement. What happens if you have bad timing and the market crashes right after you retire? Let's take a look at some actual results for 5 of the largest balanced mutual funds from T. Rowe Price, Fidelity, and Vanguard, so we can learn what happens if you have bad timing, potentially sequence of returns risk, and you're using the 4% rule in your retirement. When I say bad timing, I'm talking about retiring right here at a major market top in 2000 or 2008. What happens if you're unlucky and you retire and then the market crashes like it did in 2008, for example? Let's take a look. Our first illustration is for the T. Rowe Price Balance Fund. We are retiring with $1 million investment on January 1 of the year 2000. We are withdrawing $40,000 in the first year, 4%, and then growing that distribution by 3% every year for inflation. This is the 4% rule in action. So we start in 2000 with $1 million, and 25 years later, we have $978,000. The 4% rule worked. One thing I want to point out is that 8 years into your retirement, at one point, you were down to about $500,000. Scary ride for most people. If you had retired at 65, you would be 73 years old, and your portfolio would be half of what it was when you started your retirement. That's a lot of volatility. Not everyone can tolerate that, and we're going to talk about this later in the presentation. What is your tolerance for volatility? Because if you make a market timing mistake, if you get scared and get out, your whole retirement is upside down. Our second illustration is for the Vanguard Balanced Index Fund, one of the largest. Retiring in the year 2000 with $1 million, 25 years later, we're at $825,000. So your capital is being depleted, but for the last 25 years, the 4% rule has worked if you are using the Vanguard Balanced Index Fund. Along the way, a lot of volatility. You can see that we had sequence of returns risk in 2000. In addition to bad timing, we had several negative years of returns. And like the T. Rowe Price Fund, a lot of volatility. 2008, we were down to about $500,000. Very important that you stay invested and you don't try to market time when you're using the 4% rule in retirement. Here's what happens if you have good active management in a balanced fund. This is the Vanguard Wellington. Same asset allocation as the Vanguard Balanced Index. They're both roughly 60-40 asset allocation funds. But look at the end results. We start with $1 million January 1 of 2000. Now we have $2.5 million 25 years later. Incredible performance with this balanced fund compared to the index. And that is mostly because in the crash of 2000, in the Vanguard Wellington, they did a much better job of managing risk. They didn't have the negative sequence of returns that the Vanguard Balanced Index Fund had. So because of the better risk management in the early 2000s, when you had bad timing and then went right into a crash, your long-term results end up being much better. Here's another actively managed balanced fund that had excellent risk management during the 2000 crash. This is the Fidelity Balance Fund. If you had retired on January 1 of 2000 with $1 million and used the 4% rule throughout your retirement, today you would have $2.4 million. Great results for someone who retired, invested in the Fidelity Balance Fund, and used the 4% rule. Here's another actively managed balance fund by Fidelity, the Puritan. Not quite as good as the Fidelity Balance Fund in how they managed the 2000 crash. Ultimately, you're ending up with $1.8 million, but still a lot better than what we saw from the Vanguard Balanced Index Fund. Great results long-term for someone who had used this fund in their retirement in conjunction with the 4% spending rule. Here's a summary table for the 5 funds that we just looked at. I've ranked them by ending value. You can see that the Vanguard Balanced Index performed the worst and Vanguard Wellington performed the best. Interesting that indexes, which are the cheapest at 0.07 for this share class of the Vanguard Balanced Index Fund, greatly underperformed the Vanguard Wellington, their actively managed fund, which costs a lot more. I'd rather have $2.5 million than $825,000 personally, 25 years into retirement. That's a lot more security when you're getting up in years. Two other important details to take note of. One, the stock percentage. Every one of these funds is in the same category. Balanced funds, 60-40 asset allocation. But the return results were very different. And fees. If you look at this fee column, the expense ratios, they're all different. And what we can take away from this is that low fees don't necessarily produce the best results. Vanguard has spent decades convincing people that it's all about low fees. But if we look at their Wellington fund, which costs significantly more than their index fund, we see a huge discrepancy. Clearly, the active management in the Vanguard Wellington fund has produced much better results than their balanced index fund. Makes you think, doesn't it? This table lets us compare each of these funds during the 2000 crash, so we can see how they performed when we had bad timing and sequence of returns risk. We had 3 negative years in the stock market. Vanguard Balanced Index Fund, 1, 2, 3. Negative, negative, negative. And that is why the total return for Vanguard is so much worse for the index fund during the 3-year crash. 3 negative years, even though none of the negative years were that big, leads to a really bad long-term outcome. And their rebound in 2003, not so good, not as strong as the other funds. Keep in mind that these other funds are all actively managed. So this is where the difference comes in. Vanguard's Wellington fund made money in 2000 and 2001 because they had better positioning, better ideas, and better risk management. Ultimately, they finished this multi-year period up 28.95 versus up 3.2 for the Vanguard Balanced Index. It makes a massive difference in your long-term results. Also see that Fidelity did a great job with their balance fund in 2000 and 2001. When the indexes were losing, Fidelity was making money. So all of the actively managed funds did better than the index during the multi-year 2000 to 2003 crash. Here's what the 2000 crash looked like up close. Bad timing and sequence of returns risk. Big losses over a couple years. If you're going to use the 4% rule in retirement, it is very important that you have an asset allocation that you will not abandon when the chips are down. For example, the FireCalc tool, a very popular retirement planning tool, has a baseline assumption that you will be even more aggressive than these illustrations we're looking at, and that your baseline assumption is a 75-25 asset allocation, equity to fixed. For most people, that's more volatility than they can handle. And it's not if we're going to get a crash, it's when. I don't know when, nobody does, but you can be sure we will have a period like this, 2000 to 2013, during your retirement. If you're getting ready to retire now, you need to be mentally prepared for the fact that you will see this kind of volatility at some point in your retirement. Make sure that your asset allocation lines up with your risk tolerance if you're going to use the 4% rule. Because if you panic, if you get scared and you sell here, throw your financial plan out the window. I love using these historical illustrations showing the impact of both bad timing and sequence of returns risk. It gives us a sense of a worst case scenario. And if you can survive the worst case, then everything else is really easy. I love the sense of reality that we get from these illustrations. And also, I use these mutual funds because that's really all we have for data. ETFs were only getting started 25 years ago. They weren't that popular. It was a new industry. So I'm using these mutual funds because it's about all we can get in terms of data for a 25-year sequence. Most financial advisors rely too heavily on software for projections, in my opinion. Monte Carlo is a wonderful tool, but I really like taking a look at the historical data in conjunction with Monte Carlo. Especially if you have a younger financial advisor who has never been through something like 2008 or the year 2000, You don't have the appreciation for how people will react when the market starts crashing. I do. I know what that's like. I've been through it before. And it's amazing how many people will freak out when the market starts dropping, especially a couple years in a row like 2000. Again, financial planning software has some serious shortfalls. And the big shortfall, in my opinion, is that the planning software doesn't know you. It doesn't know how you feel about your money. So that's why I love to run these illustrations and show what really happened in the past if you were retired using the traditional 60-40 balanced fund allocation and withdrawing 4% of your money, growing it for inflation. Can you tolerate the volatility? Are you okay with what you see here? Not everybody is. If you think of the Vanguard Balanced Index, for example, in that illustration, and T. Rowe Price, you got down to about $500,000 8 years into your retirement. Many people would just throw in the towel if that happens to them. So it's important that you get your asset allocation right in addition to your spending strategy, something like the 4% rule. If your financial advisor isn't talking to you about your spending plan in retirement, please give my office a call. We would be happy to give you a second opinion on your retirement plan. Now let's take a look at the 2008 pattern. What happened if you retired in 2008 before the crash and used these same funds and used the 4% rule? Where would you be today at the end of 2024? If you had retired on January 1, 2008 with the T. Rowe Price Balance Fund, $1 million, used the 4% rule, 17 years later, you have $1.3 million. This time, the Vanguard Balanced Index Fund did better. If you retired on 01/01/08 with $1 million, used the 4% rule, and invested in a Vanguard Balanced Index Fund, 17 years later, you have $1.6 million. But much like the first illustrations, active management can perform better over time. This is the Fidelity Balance Fund. $1 million investment on January 1, 2008. Use the 4% rule. 17 years later, we have $1.7 million. Fidelity Puritan, also at $1.7 million. And finally, for the Vanguard Wellington, if you had retired on January 1, 2008 and used the 4% rule, today you would have $1.7 million, also ahead of the index. Here's the distribution of ending values. Once again, T. Rowe Price and Vanguard Balanced Index had the lowest returns. This time, Fidelity Puritan was in the lead. Even though Fidelity Puritan costs significantly more than the Balanced Index, 0.07 versus 0.48, you ended up with significantly more money. Over time, active management can produce better results. That's not always the case, but it is possible. The other side of active management is a manager who costs you money in the long run due to underperformance versus the index, as in the case of T. Rowe Price. This is the highest cost fund on this list, and it's had the worst performance. I still find it interesting, however, that Vanguard, who has the index fund and who has promoted indexes forever, also has a fund right here, the Vanguard Wellington, that costs a lot more than the index, relatively speaking, but also has had better performance. Here's a summary table that shows us how these funds navigated the crash of 2008. If you had retired on January 1, 2008 and used any of these funds with the 4% spending rule, here's where you ended up on a total return basis after 2 years. 2 years later, your total return on T. Rowe Price Balance, for example, was minus 8.67. For Vanguard Wellington, it was minus 5.49, or the index minus 6.89. Again, we see that the actively managed fund, the Vanguard Wellington, is beating their index fund. In all cases, we see losses after the crash. There was just nowhere to hide in 2008. So when you're working on your retirement plan, it is important that you know the volatility parameters for the assets that you're investing in and that you are comfortable with the potential for losses as you move into retirement. If we study this chart, it shows us what we're up against going forward. There is a very clear boom-bust pattern in the stock market. We're looking at the S&P 500 all the way back to the 1950s. The green arrows are bull markets, the red arrows are bear markets. Boom, bust, boom, bust. The cycle just keeps repeating. So if you're getting ready to retire now, where we are late stage bull market, we've been in a bull market for over 16 years now. So if you're getting ready to retire in 2025, 2026, it is extremely likely that you're going to see one of these red arrow markets where we have no return on price for a decade or longer. It's going to happen in your retirement. So you need to make sure that your financial plan and your investment strategy can withstand what's coming. So let's add it all up. If you had retired in 2000 or 2008 and you had bad timing and you were using some of the most popular balanced retirement funds and the 4% spending rule in retirement, you still have money today. It worked out. You even were able to withstand sequence of returns risk of the early 2000s, the 2000 to 2003 period with the 4% rule. Now, past returns tell us nothing about the future returns, but they give an idea to us of what can happen under really adverse conditions. The 4% rule has worked under both of these bad situations. What's critical, in my opinion, is that you have to stay invested. That is one of the big assumptions of the 4% rule. You stay invested the whole time. And as I've shown over and over in this video and many other videos, when you get volatility, you don't want to get out because you can get hurt really quick. And I've seen a lot of people do that. It happened to so many people circa 2003 and 2008. Really smart people. I've built hundreds of financial plans over the last 25 years, and I find that when we are in good times, people are more willing to take risk, or they will brush off the potential for losses. It amazes me how many times I've met with people and they kind of ignore the potential for losses when times are good. Like right now at the end of 2024, the overconfidence is off the charts. But then when the inevitable crash comes, a lot of people suddenly panic. And it's always intrigued me the number of people who say, oh yeah, I'm willing to take, I'm a 7 on a 1 to 10 scale, for example. But then when the volatility comes and you're still within those volatility parameters, that same person sells out of the market. It happens all the time. Don't let it happen to you. Make sure that your financial advisor is not overly reliant on Monte Carlo simulations and financial planning software. That stuff is great, but they better understand investments and they better understand you, because if they don't, when the bad times come, and they will come, there's a higher likelihood that you'll cash out at the bottom. I know it sounds crazy, but people do it all the time. And when you're 70 or 75 years old and you're watching your retirement nest egg dwindle, it's like an incredible amount of weight on your shoulders. There's a way to get around that. Have a solid financial plan and know what to expect before things get bad. As far as the 5 funds go that we covered in this illustration, I'm not recommending any of them. I'm just using them for illustrative purposes so you can get an idea of what happened under very adverse conditions for people using the 4% rule with standard retirement investments. They might not be right for your particular situation. Not everyone can handle, from a risk perspective, a 60-40 asset allocation. I know it's a standard retirement asset allocation, but there are people who would balk at 60% in equities in retirement. And I'll bring up the FireCalc tool again. Be careful when you use that tool. It's a great tool, but the baseline assumption there is 75-25 equity to fixed. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.